Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 11.22 of Unit 11, Algorithmic Trading Fundamentals. In this lesson, we're going to cover three essential ideas. What commission structures mean for traders, why commissions matter to trade profitability, and a quick preview of how you will apply this knowledge to your own trading plan. By the end of this video, you will understand how brokers charge you, how those charges can shrink or even erase your gains, and what to look for when you compare broker fee schedules. Think of commissions like the tolls you pay on a highway. You can still reach your destination, but every toll reduces the fuel you have left for the journey. We'll walk through simple analogies, real-world numbers, and a step-by-step checklist so you never get surprised by hidden costs. This is pure foundation work. No code, no complex math, just clear concepts you can start using today. So grab a notebook, settle in, and let's dive into the world of commission structures and see how they shape every trade you make. Now let's unpack what commission structures actually mean for traders like you. A commission is simply the price you pay a broker for the privilege of entering a trade, much like paying a cashier a fee for using a credit card. Brokers can choose from three common ways to collect that fee. The first is a fixed fee, which is a flat amount you pay every time you open or close a position, regardless of trade size. Imagine paying a $5 parking ticket each time you pull into a lot, no matter whether you stay 10 minutes or 2 hours. The second model is a spread markup. In the Forex market, there is already a built-in spread, the difference between the buying price, ask, and the selling price, bid. Some brokers add a small extra amount to that spread, say an extra 0.2 pips, and keep the difference as their commission. Think of it as a store adding a tiny surcharge to the price tag. The third model is a per lot fee, where the broker charges a set amount for each standard lot you trade, typically $2 to $4 per lot. If you buy one lot of euro to US dollar, you pay that fee once. If you buy 2 lots, you pay twice. This is like buying groceries where each bag costs an additional handling fee. Understanding which model a broker uses helps you predict the exact cost of any trade, because each model reacts differently to trade size, frequency, and market volatility. In the next scene, we'll see why those costs matter for your bottom line. Why do commissions matter to trade profitability? Let's picture a simple scenario. Suppose you start with a $10,000 account and you make 5 consecutive winning trades, each adding $500 gross profit before any fees. Without commissions, your balance would climb to $12,500 after those 5 trades. Now introduce a modest commission of $10 per trade, which is common for a per lot fee on a 1 lot euro to US dollar position. After each trade, you lose $10, so the net gains become $490 per trade. After 5 trades, your balance ends at $12,450, a $50 shortfall caused solely by commissions. That $50 might look tiny, but over a year of 200 trades, it becomes $2,000, eroding roughly 16% of your gross earnings. The impact grows larger if you trade smaller profit targets, trade frequently, or use a broker with higher fees. Think of commissions as tiny leaks in a bucket. Each leak may seem insignificant, yet over time the water you lose adds up and can even cause the bucket to overflow with loss if you're not careful. This is why every trader, especially beginners, must factor commissions into their risk-reward calculations. If you aim for a 1-to-2 risk-reward ratio, you need to ensure the potential profit still exceeds the total commission cost. By always subtracting the expected commission from your projected profit, you keep your trade plan realistic and protect yourself from surprise shortfalls. In the next lessons, we'll calculate exact costs for a euro to US dollar trade and show you how to adjust position size so commissions never eat into your risk management. Welcome back, looters. Let's dive into the 3 ways brokers charge you for a trade. Think of a commission like the fee you pay to ride a bus, cross a toll bridge, or buy a coffee. Each is a different kind of cost, but all affect your budget. The first model is a fixed commission. Imagine you pay a flat $5 every time you step onto a bus, no matter how far you travel. In Forex, a broker might charge a fixed $5 per trade, whether you buy 1 micro lot or a full standard lot. The second model is a spread commission. A spread is the tiny difference between the price a broker will sell you ask, and the price they will buy from you bid. It's like a store marking up the price of a product. If the spread is 0.1 pip on euro to US dollar, and each pip is worth $10 for a standard lot, that spread costs you $1 per trade. The third model is a per lot commission. This is similar to a toll bridge that charges you based on the weight of your vehicle. The heavier the load, the higher the fee. In Forex, a broker may charge $2 for every lot you trade. So a 2-lot trade costs $4 in per lot commissions. Each model impacts small and large trades differently. Fixed fees hurt tiny trades more, while per lot fees grow with trade size. Understanding which model your broker uses helps you estimate how much each trade will truly cost you before you even open a position. Your practical takeaway: look at the broker's commission schedule, note the model, and calculate a quick example trade to see how the fee will affect your profit or loss. Now let's walk through a real-world example using the euro to US dollar pair, which is the most traded currency pair in the world. Suppose you decide to buy one standard lot, that's 100,000 euros, at an entry price of 1.1000, and you close the trade at 1.1050, a 5 pips move in your favor. First, let's calculate the raw profit before any fees. Each pip on a standard lot of euro to US dollar is worth $10. So 5 pips equal $50 profit. Next, we apply the broker's commission schedule. Our broker charges a fixed commission of $4 for every trade, regardless of size. Then there's a spread commission of 0.2 pip. Since each pip is $10, 0.2 pip costs $2. Finally, there's a per lot commission of $3 for each lot traded. Adding those up, for dollars fixed plus $2 spread, plus $3 per lot equals $9 total commission. Subtract the $9 from the $50 gross profit, and you end up with a net profit of $41. This example shows how a seemingly small fee can shave off a noticeable chunk of your earnings, especially on short-term trades where the profit target is modest. The key lesson here is to always factor in every commission component before you set your profit goal. If you expected a $50 gain, but forget the $9 cost, you might be disappointed when the trade closes. Your practical takeaway: write down the exact commission numbers from your broker, plug them into a simple profit calculator like we just did, and only then decide if the trade's reward justifies the cost. Finally, let's put everything together and calculate the total cost of a one-lot trade from start to finish. We'll reuse the euro to US dollar example, where you buy at 1.1000 and sell at 1.1050, a 5 pip move. Step 1. Calculate the gross profit. 1 pip on a standard lot of euro to US dollar equals $10. So 5 pips give you $50 before fees. Step 2. List each commission component. Our broker schedule says fixed commission $4 per trade, spread commission 0.2 pip, and per lot commission $3 per lot. Step 3. Translate the spread into dollars. With a pip value of $10, 0.2 pip costs $2. Step 4. Add up all commission costs. For dollars fixed plus $2 spread plus $3 per lot equals $9 total commission. Step 5. Subtract the total commission from the gross profit. $50 gross profit minus $9 commission leaves you with a net profit of $41. This net figure is what actually lands in your account after the broker takes its cut. Notice how the commission reduced your profit by 18%. A significant bite when your trade only moved 5 pips. If you were aiming for a $30 profit, the $9 commission would have turned a winning trade into a loss. That's why many traders either look for larger price moves or choose brokers with lower commission structures. Your practical takeaway: always write out a simple cost table before entering a trade. List entry price, exit price, pip value, each commission type, then compute net profit. This habit ensures you never trade with hidden costs eating your gains. Let's picture how a commission changes the look of a profit chart. Suppose you buy one standard lot of euro to US dollar at 1.1000 and plan to sell at 1.1050, a 50 pip move. In a world with no cost, that would appear as a clean green bar on your chart, representing a $500 gain because each pip in a standard lot equals $10. In reality, Every broker takes a fee. Imagine the broker charges a fixed $7 commission each time you open or close a trade, and also builds a 2-pip spread into the price you receive. That spread alone costs you $20, 2 pips times $10. Adding the $14 total commission by plus sell reduces your real profit to $466. To make this visual, we draw 2 green lines on the same price-time axis. The top line, bright green, shows the gross $500 profit. Directly beneath it, a slightly lower green line, labeled net after commission, ends at $466. The thin gray gap between the lines is marked commission cost. That tiny distance is the money that disappears before you even think about risk or market moves. By glancing at the chart, you can instantly see that even a modest fee can shrink a winning trade, especially for short-term strategies where each trade earns only a few pips. The visual also lets you compare brokers. A broker with a $3 commission per side would create a smaller gap, while a $10 commission would widen it dramatically. The key takeaway is to always plot commission on your profit and loss chart, so you never overestimate how much you're truly making. A common rookie error is to forget about commission when you calculate how much a trade earned. Think of it like buying a candy bar for $1 and then walking away without paying the sales tax. You think you spent $1, but the register actually takes $1.08. In Forex, the same thing happens. Imagine you open a standard lot of euro to US dollar at 1.1000 and close it at 1.1030, a 30-pip rise. Each pip is worth $10, so the raw math says you made $300. If you stop there, you are ignoring 2 hidden costs. First, the broker's spread, let's say 2 pips, already ate $20 before you even entered the trade. Second, the broker charges a $7 commission each time you open and close, adding another $14. Together, those fees total $34, leaving you with $266, not $300. Some brokers also add a small per-lot fee, which could bring the total commission to $42, reducing the final profit to $258. When you see a profit figure on your screen that looks great, pause and ask yourself, did I subtract the spread and all commissions? If you answer no, you are likely overestimating your earnings. The visual on the screen shows the bright green box of the calculated $300 profit and a red warning sign that says commission not included. Below it, a smaller green box reveals the actual $258 after subtracting the $42 commission. The lesson is simple. Always include every fee in your profit calculation, or you'll think you're winning when you're actually just breaking even. Even after you factor in the obvious commission and spread, many brokers hide extra charges that silently chip away at your returns. Think of these hidden fees like tiny holes in a bucket. You keep pouring water in, but a few drops always leak out. The first common leak is the inactivity fee. Some brokers charge, for example, $10 each month if you haven't opened or closed a trade in the last 30 days. If you take a break to study the market, that $10 quietly reduces your capital. Next is the withdrawal fee. While you may earn a profit, pulling that money out could cost you a flat $5 per transaction, which adds up if you withdraw often. Then there are data feed fees. Premium real-time quotes can cost $2 per day, a cost many beginners overlook because it's bundled into the platform's interface. Account maintenance fees are another subtle drain, often $3 per month just for keeping the account open, regardless of activity. Finally, currency conversion fees appear when you deposit or withdraw in a currency different from your account's base. A typical rate might be 0.1% of the amount, which can be several dollars on a modest deposit. To visualize these, the infographic shows each fee with a red warning icon and a short description. By recognizing each hidden charge, you can ask your broker up front, do you have an inactivity fee? What is the withdrawal cost? And then factor those numbers into your overall profit plan. Ignoring them is like assuming a car gets 30 miles per gallon when the air filter is clogged. It looks fine on paper, but performance suffers. The practical rule: write down every fee you discover, add them to your trade cost worksheet, and only then decide if a trade still meets your profit target after all expenses. All right, looters, Let's walk through the exact steps you need to take when you first open a broker's website and want to understand how they charge you. Think of it like reading a restaurant menu before you order. You need to know the price of each dish so you don't get a surprise bill later. First, log into your broker's portal and look for a link called Pricing, Fees, or Commission Schedule. This is usually found in the footer or under the Account tab. Click it, and you'll see a table that lists the different ways the broker can charge you. The first row is often labeled Fixed Commission. This means you pay the same amount no matter how big or small your trade is. For example, Broker X might charge a flat $5 per trade. The second row is Spread Commission, which is the difference between the buying price and the selling price, expressed in pips. If the spread is 1.0 pip on euro to US dollar, that cost is built into the price you see on chart. The third row is Per Lot Commission, where the broker charges a set fee for each standard lot, 100,000 units. An example could be $2.50 per lot. Below the table, you might see tiered discounts. If you trade more than 10 lots a day, the per lot fee could drop to $2. Finally, scan for any footnotes about hidden fees, such as overnight financing or inactivity charges. Write down each number in a notebook or spreadsheet, because you'll need these exact figures when you calculate the true cost of every trade. Remember, knowing the schedule up front is the first step to protecting your trading capital. Now that you have the commission numbers written down, let's see how they fit into your trade plan worksheet, which is basically a cheat sheet you fill out before you press that buy or sell button. Imagine you're planning a trade on the euro to US dollar pair. You decide to trade one standard lot, which is 100,000 euros. Your entry price is 1.1000, and you aim to exit at 1.1050, a 50 pip move. In a typical Forex calculator, each pip on a standard lot is worth $10. So your gross profit before any fees would be 50 pips times $10, equaling $500. That's the number you see in the gross profit column. Next, pull the commission figure you recorded earlier. Let's say the broker charges $2.50 per lot. Write $2.50 in the commission column. To find the net profit, simply subtract the commission from the gross profit. $500 minus $2.50 equals $497.50. Put that result in the net profit column. This net figure is the money that actually lands in your account after the broker takes its cut. By filling out the worksheet before you trade, you instantly see how much you stand to earn, and you avoid the nasty surprise of a smaller balance after the trade closes. It also helps you compare different brokers. If another broker charges a $5 flat fee, your net profit would drop to $495, which might influence your choice. The key takeaway is to always record the commission on the same worksheet you use for entry, exit, and risk, so every trade's true profitability is crystal clear. Finally, let's tie commissions into the core of risk management, which is all about protecting a small portion of your account on every trade. Think of risk management as a safety net you set up before you walk a tightrope. A common rule for beginners is to risk no more than 1% of your total account on a single trade. If you have a $10,000 account, that means you can only afford to lose $100 if the trade goes against you. Now, add commissions to the mix. Suppose your broker charges $5 per trade. That $5 is money you lose whether the trade wins or loses, so it effectively increases your total risk. To keep your risk at the intended $100, you need to subtract the commission from the amount you're willing to lose, leaving $95 for the actual market move. In practice, you calculate the distance to your stop loss in pips, then determine how many lots you can trade so that a loss of $95 equals that pip distance. For example, if your stop loss is 20 pips away, each pip would need to be worth $4.75, $95 divided by 20. Since one standard lot makes a pip worth $10, you would trade roughly 0.475 lots, or round down to 0.4 lots for simplicity. This smaller position size ensures that even after the $5 commission is taken, your total loss never exceeds $100. The same logic works when you're planning a profitable trade. Subtract the commission from your expected profit to see the true net reward. By consistently adjusting position size for commission expenses, you keep your risk calculations honest and avoid unintentionally blowing up your account. Remember, commissions are a fixed cost, so they belong in the risk equation just like your stop-loss distance. All right, looters, now that we know commissions are like a small toll you pay every time you drive your trade car across the market road, let's talk about how you can adjust the size of your car, your position size, so that the toll doesn't drain your earnings. Imagine you want to buy one standard lot of euro to US dollar, which is 100,000 euros. If your broker charges $7 per lot, that $7 is taken out of your profit no matter how well the trade moves. If the price only moves a few pips, that $7 could be a big chunk of your gain. To keep the toll from swallowing your profit, you can either choose a smaller lot or trade fewer lots. For example, instead of one lot, you could trade half a lot, also called 0.5 lot, which is 50,000 euros. The commission is then half of $7, so $3.50. Let's say the euro to US dollar moves up 10 pips. A full lot would earn you roughly $100 because each pip on a standard lot is about $10. After paying $7 commission, you keep $93. With a half lot, the 10-pip move gives you $50, and after a $3.50 commission, you keep $46.50. Notice the net profit ratio stays the same, but the absolute dollar amount of commission is smaller, which matters when you're just starting and your account balance is modest. The rule of thumb: calculate the commission per lot, then decide if a smaller lot keeps the commission proportion reasonable compared to your expected profit. If the commission would be more than 10% of your anticipated gain, shrink the position size. This simple adjustment protects your account from hidden erosion and lets you trade with confidence, even when the market moves just a little. Remember, the goal is to let the market move in your favor, not to let the broker's fee move against you. Let's take a moment to bundle everything we just learned about commissions into a neat, bite-sized package you can refer back to anytime. First, think of a commission as the entry fee you pay each time you step onto the trading floor. It's a small amount the broker collects for handling your order. There are three main ways brokers charge this fee. The fixed model is like paying a flat ticket price no matter how big your purchase is, say $5 per trade, regardless of whether you buy one lot or 10. The spread model hides the fee inside the difference between the price you can buy, ask, and sell, bid. The broker adds a few extra pips to the spread, which is the cost you pay indirectly. Finally, the per lot model charges a set amount for each standard lot you trade, such as $7 per lot on euro to US dollar. In our real-world example, buying one standard lot of euro to US dollar would cost you $7, while a half lot would cost $3.50. To find the total cost of a trade, simply multiply the commission per lot by the number of lots you plan to trade, then add any hidden fees like platform fees or overnight financing. A good rule of thumb is to keep commission costs below 10% of your expected profit. If the fee would eat more than that, consider reducing your position size. Adjusting the lot size is the simplest way to control commission impact without sacrificing your trading plan. By consistently reviewing your broker's commission schedule and plugging those numbers into your trade plan worksheet, you make sure every trade's profit and loss picture is crystal clear. Remember, knowing exactly how much the toll costs lets you drive your trading journey with confidence and avoid surprise expenses that could derail your progress. That wraps up Lesson 11.22, Commission Structures. If this walkthrough helped you see how broker fees fit into the bigger picture of trade profitability, go ahead and smash that like button so other beginners can find this guide. Don't forget to subscribe to Tick to Loot and click the notification bell so you never miss a future lesson that turns complex concepts into simple steps. Drop a comment below sharing which commission model you're most likely to use, or tell us about a hidden fee you discovered in your own account. Sharing helps the whole looter community grow together. Remember, mastering commissions is just one piece of the puzzle, but it's a piece that protects your hard-earned gains and keeps your trading plan honest. Keep reviewing broker schedules, keep adjusting your position size, and keep linking every cost back to your risk management rules. As always, practice these steps on a demo account first, because real-world trading is a marathon, not a sprint. Thanks for hanging out, looters. Keep turning those ticks into treasure, and I'll see you in the next lesson. Happy trading!